Hello monsters, this is Fahad. I'm back. I'm going to take a look at one of my favorite stocks from 2015, Adeptus Health, symbol ADPT, Adeptus Health. Now I have a lot of content to cover here, but I like to keep these videos within 10 minutes or 11 minutes at most, so hopefully I can skip through a lot of the details and then just fly through a lot of the details and cover as much ground as possible. Adeptus Health was, many of you may remember, was one of my top 10 picks from 2015. I made this one of my top 10 picks at the start of the year. Here's the weekly chart when the stock was trading at $38, $39 a share. Subsequently, over the course of, by the middle of the year, this thing was trading at $123 a share. It was up like 200 to 300% before it came crashing down big time and went through this large corrective phase. To quickly point out exactly what happened that caused the big crash and big sell-off, there were three major events. Oh my God, I hate that sound. There were three major events that basically affected the stock after it reached $120, $130 a share. One has to do right here in September when Hillary Clinton opened her mouth that sent the entire biotech sector just tumbling down big time. See this big giant sell-off in September? That's what all started it. I mean, just to quickly show you, if I look at the IBB chart, right here is September. From in that September, over the course of 10-day period, IBB basically went down 20%. 20% sell-off in IBB after Hillary started talking. So here is Adeptus Health. Same exact thing happened over here. The stock went sharply down. Then in October it reported earnings, and immediately after that earnings, the stock sell off big time because there was a short recommendation that was issued by a specialty research shop called Lakewood Capital. Lakewood Capital is no different than Muddy Waters or Citron Research. They basically just like to short a bunch of stocks all the time. So that's what they did, and the stock sold off again in October. And then lastly, in November, the stock sold off again big time. At that time, it was created by a local story that was published in a news network in Colorado discussing that Adeptus Health was overcharging some of its customers. And so some customers were complaining, and Colorado local news network, local TV channel decided to basically issue a story on that. That was in November. So Hillary opened her mouth in September. Stock sold off. Lakewood Capital issued a new short recommendation in October. Stock sold off. And Colorado local newspaper or local news TV network published a story, and the stock sold off. All it has done is basically it has brought the sentiment back to now, which is very reasonable, and I think that it is now presenting just another new buying opportunity. Could be short-term, could be long-term buy on hold. I'm expecting a stock to break out from here. Company is reporting earnings tomorrow morning. Tomorrow morning, before market opens, the earnings are going to come out. And I expect the stock to break out through $60 a share from right here and possibly make a move higher, as high as all the way to $78 and $79 a share. See these volume over price resistance supports and resistance right here? So here is, if I put my finger right here, you're looking at around 6150, call it actually right here, around 61 to 6150 as major volume over price resistance. If we break out over here, I think you can see first a small short-term target is going to be about 65.70, and if it breaks out from here, you're going to see this rise all the way to $79 to $80 a share. That basically filling the gap way back from October all the way to $79.80. So your first target is 65.50, let's call it, which is about 10% upside from here. And then your secondary target over intermediate term, give it about a couple months for this possibly to play out, is all the way to $79 to $80 a share, which is 30% upside from here. 30% upside from here. And so now, so that's the technical picture. So what I'm looking at in this, in the fundamental side, just to quickly mention. Here is my note. Let's go back to my notes. These are from all activity trackers. You can take a look at it. I want to dive actually a little bit in the back in the previous numbers just to kind of show you where we're coming from. So let's go back all the way to February 2015. This is last year, February 2015. Guess what the analysts as well as the company was guiding at that particular time? For fiscal year 2016, the company was, at that time, they had raised the estimate slightly from 92 cents to $1.03. So, you know, this is this year, fiscal year 2016. Everybody was expecting, okay, the company is raising guidance from 92 cents to $1.03. So obviously, when the stock was trading right here in a couple months later by the summertime, all the way towards $100, $110 a share, everybody was freaking out, saying, oh my God, this thing is trading at 100 times forward earnings. The valuations are outrageous for a healthcare facility stock, blah, blah, blah. Everybody was missing the big point. I mentioned this multiple times. Those forward earnings estimates are way too low. The forward PE multiple will contract sharply because there's a simple mathematics here that everybody forgets. It's a very simple mathematics here that everybody forgets. Let me just, I mean, if I go to, let's go here. If I go here, all you have to do is go to Open Order Pro. Go to all the way to January right here 15, and all you have to do is pull up my top 10 picks for 2015. Here is the file, and as you pull the file, oops, all you have to do is right here. This is where I laid out my bullish thesis, and one of the simplest thing that I mentioned is right here that basically explains everything that you need to know. Let me explain right here. Where did it go? Basically, I mentioned one thing over here that this company is cash flow positive on every single facility that opens, and that was my main thesis, primary thesis that everybody basically missed on in the analyst community side. Everybody missed. I explained this in detail right here. Okay, this is where I mentioned each facility generates approximately $5 million in revenues and run on an operating margin of 20 to 35%, resulting in $1.5 million free cash flow. They're running at around 30% of occupancy rate, which is not very impressive, but that's only because the Medicaid patients yet to come. To me, right here's the bottom line. To me, the most beautiful thing about business model is they are free cash flow positive on every facility. The company can continue to grow organically, and this one chart shows you the whole picture. So basically, the bottom line I'm trying to make is that everybody missed the simple logic that they were making a case that the stock was too expensive, trading at 100 times forward earnings, because they failed to take into account it's a fixed cost structure. See, this is where my simple accounting and finance skills from my college and my previous life come into play. Everybody missed a simple fact that this is a fixed cost structure. Okay, and so every sale that they make has a significant impact on the bottom line, which means the forward earnings multiple will drop sharply as the volume increases. It's very simple math, and if people don't get it, I don't know what to tell them. And guess what happened? Going back to my article, so last year in February 2015, the company was guiding $1.03 EPS. 1 year later, this is what we saw. This is the last quarter, February 24, 2016. This was 2 months ago. For the Q4, EPS was 45 cents versus 36 cents estimates. Revenues was 105 million versus 96 million estimates. Big beat. And guess what? Fiscal year 2016 EPS guidance 255 versus 216 estimate. I mean, 1 year ago they were guiding $1.03 for this year EPS. And now they're guiding $2.55, which beat the highest estimates on the street of 216. Look at the revenue guidance, 650 million for this year versus 476 million estimate. Monster beat. I mean, you're talking about one of the best beats that I saw when I was looking at Q1 earnings report coming out from a bunch of companies. One of the best beats we saw. But guess what? This story gets even better. To show you, right here is a note from, let me see, where did it go? I need to pick this up. There is a note from right here. This one comes from Bank of America. This was on March 11. Right here. This one comes from Bank, which makes me think that the future 2016 EPS is even less. Now, to quickly walk you through, there's a lot of details over here, so I'm not going to have you read the whole thing. I'm just going to explain it to you, so just listen up. Back in February, the company signed a new partnership with the Ohio facility called Mount Mount Carmel Hospitals, which basically gives the company access to 8,000 patients in Ohio, in the state of Ohio. This was the only fifth state that the company has entered. Fifth state in the company that has entered. There are 45 other states the company has yet to enter. This is far from saturation. It's a coast to coast. Eventually, they're gonna grow coast to coast. What happens with this joint venture is, and after talking with management, Bank of America talk about this in this particular research report. Bank of America sees a 23% increase in 2017 EPS after this joint venture. They also believe that this is one of several, many joint ventures to come as the company enters into different markets, different states. And again, they're only in 5 states currently. Okay, so just based off of this one joint venture that was signed with Ohio Hospital System in February, Bank of America see 23% increase in the fiscal year 2017 EPS. That's why Bank of America has a $90 price target. All right. Now that sounds very interesting, except when you go to the, where did it go? Not here. When you go to the, I need to keep finding my screenshots. Right here. If I go here, right here, and maximize this, Bank of America is talking about fiscal year 2016 EPS basically increasing by 23% after this joint venture that was signed in February. And yet, you take a look at what the consensus view is doing, nothing. Yes, it has increased sideways a little bit. It was down a little bit in late 2015 and then up. And then basically, if I look at where the consensus EPS estimated for fiscal year 2017, it's at 360, same spot where it was back in October, November of last year. So the consensus estimates has not increased. Also on the simple multiple side, look at what happened. Remember when everybody was shooting against this in early 2015, calling it the stock was trading at 100 times forward earnings? Guess what that forward earnings now look like? You know, in a couple months we're going to be doing it the second half of 2016, which means everybody was going to start assigning multiples based on what the 2017 EPS looks like. They're no longer going to be looking at 2016 EPS. Before adjusting for the 23% increase that Bank of America sees in the fiscal year 2017, before adjusting for that, the EPS is already 360, rising steadily every year. If I simply do the math, 59.72, where the stock is trading right now, divided by 3.6 is trading at 16.5 times earnings. Increase that 3.6 by 0.23. And you're looking at about $4.40 earnings power, which means the stock is trading at, actually, realistically, at 13.5 times earnings. How does that sound? 13.5 times fiscal year 2017 earnings versus 100 times earnings that everybody was looking at. Now it doesn't sound so bad, does it? Anyways, this is what I'm expecting. The bottom line is this. I expect the company is going to report a monster quarter. Now tomorrow morning, I think the stock is going to pop. They've already proven it by sharply increasing guidance back in February. So we have a pretty good quarter that was already reported a couple months ago. MACD is is gradually moving higher. RSI is stable. You know, fundamental story that we just went through. So how will I make a play? I think if it breaks out here, your first target is 65.50 right here. So that's your first target, and after that, the second target is all the way to 80. So keeping that in mind, this is what I'm looking at. See this? Somebody bought earlier 200 May 60-70 call spread. So it's a straight up earnings play. And about 70% of this 500 volume that is taking place in May 50 puts were being sold to open. So they're selling May 50 puts, and they're using some of those proceeds to buy May 60-70 call spread. And I think that is the easiest way to play. Now, I think because it can pop, I don't think you even have to do the spreads. The options are not cheap over here. I mean, look at these. I mean, these things are going to cost you 8 to 9% of the underlying, even if you go with the front month, May. If you go further out in June, 60 strike calls, you're going to be spending, you know, maybe close to $6.50 or $7 per contract for June 60 calls, which is about 12 to 13% of the underlying. So options are not cheap over here. So how would I play this? You're making a strictly an earnings play. Two ways to play this. I suggest buy straight May 60 calls, pay no more than 520, 530. Straight May 60 calls, paid no more than 520, 530. This is strictly an earnings play, so keep the order size to the risk that you're willing to take going into earnings. Alternately, if you want to lower the cost, you can do May 60, 70 call spread, and then maybe you can get that fill for about $4. In fact, you may have a hard time getting a fill for $4 too, but I think you might be able to. 60 to 70. The only problem doing a spread is that $4 for a $10 wide spread, frankly, is not attractive. It's less than three reward over risk profile, and I'd like to see more than that. So I suggest going with a straight May 60 calls. You look for a pop tomorrow when the company reports another blockbuster earnings. Your target is 65.50 right here, but it could pop all the way to fill this gap from October all the way towards $80 a share. Then you can either roll calls at that point or convert it into a vertical spread or do something else at that point. Keep order sizes limited to a position that you are willing to lose. That's the most important thing. That's it.